Morning, everyone. Thanks for joining in. We'll just give it a couple of minutes for more people to come in. I think the basic idea is we're going to start with a few polls, so I would like maximum participation on that front. All right, I think we can begin. I don't really see more people joining in. So, first off, thank you to everyone who's here today and participating in Learning Saturdays. This is our initiative at I Thought, where we're dedicating Saturdays to the effort of making ourselves more aware of what's happening in the markets, familiarizing ourselves with different products, as well as addressing certain behavioral trends that are there in the market. So, I think the first shout out to everyone who's taken time out to sort of spend this Saturday learning something new. Today, we wanted to talk about the power of rebalancing because Sphere is a multi asset product. We do look at rebalancing opportunities. More importantly, I think as um, an investor, right? This is a question that's pretty much top of mind as to what to buy, what to sell. And given that context, we thought it made a lot of sense to have a webinar on rebalancing. What is the power that rebalancing has? What role does it have to play in your wealth creation journey? And how do we think about a portfolio as a whole construct? So I hope this webinar is helpful to you. And if you do enjoy this webinar, feel free to leave us a review on Google. You can look up iThought and then just drop a review on how you think our engagements are. So let me start with the presentation and I'm going to launch the first poll. It will come into your window. So you just have to click on this. This is an anonymous poll. So nobody's going to know what you voted for. So be as honest as possible with all the polls that are there throughout. So you can just answer the first poll. You can ignore the next two. Or I think, okay. I guess you would have to submit all the answers there. So I think you can just quickly, so there will be a poll on your screen. Why don't you just respond to that instead of the alphabets? Because uh, that would ensure that all of us can see the results in a uniform manner. Oh, okay. I think you can log into Teams from the web browser itself, right? You don't need to have a Microsoft subscription. Okay, I'm just going to give it another minute because only 4 people have responded. So if we can get everyone to respond to the poll, that would be great. Good answer. Okay, so, all right. Okay, so the way that I see it right now by looking at what's in the chat as well as what's coming up, people are worried. Also, I think there's an equal uh, the first, second, and third option in terms of returns, where to invest, and market volatility. Most people don't seem to be too bothered about when to invest, which is actually quite an interesting observation, right? So as far as Q&A is concerned, feel free to like either leave your questions in the chat or in the Q&A section, and I'll be taking Q&A towards the end of the webinar. All right. So I think this is reflective of what the investor's dilemma is actually today, right? We all think about whether it's a good time to invest, meaning should we do it now? Should we do it later? Should we be a little bit more aggressive with where we're investing, or should we try to be a little conservative because we really don't know what's going on and how things will progress from where we are today? We may also be looking at asset allocation questions, right? So is it a good time to invest in India or should we be looking at investments abroad, right? Is there a need to think globally at this point? And because there are quite a few answers that showed up for market volatility, I think it's a valid question to ask yourselves when you see the markets are down. The conventional wisdom tells us that, in a market correction, we need to participate, right? But how do you participate is the important question. So should you be buying the dip, meaning do you add the same ideas again and again? Or is this a time where you have to actually come back to the drawing board and think about restructuring your portfolio and looking at fresh ideas? And of course, again, another asset allocation question is, okay, is this the time to buy stocks or should I be looking at another asset class altogether? Now, when you are an investor, this is a natural dilemma to have. These are questions that are constantly keeping us up at night, right? And this is what you want to solve for when you're trying to structure a product. So, what can we do to solve this dilemma? I think if you're thinking about when to invest, uh, meaning if you're worried about, okay, if I invest today and the market's correct, will I feel bad about that decision or would I have made the bad choice? Should I have been a little bit more patient in my investing? I think the solution to this is to have a process where you're investing continuously, right? So if you're a mutual fund investor, you of course have an SIP as an option that allows you to continuously participate in markets. But I think as every investor should do, you need to have the time investments as well. And you don't need to put all your liquidity into a one-time opportunity. It's something that you can actually stagger over across the year because there'll be at least a few investment opportunities through the year. The second thing, of course, is to manage risk dynamically. So I think the basic understanding that many investors have of risk is that, if you do something, certain things are stereotyped as aggressive investment and certain things are stereotyped as conservative investment. But whether you have a conservative investment or an aggressive investment actually depends on the context in which you make that decision. It's not by nature that something is aggressive or by nature that something is conservative. There is a certain natural element to it, but I think more importantly, when you make certain decisions, actually defines the level of risk that you're taking. So if, for example, in a cyclical bottom, you pick up something, the risk level at that point is much lower. Whereas if the same investment you buy it at a cyclical top, you're actually taking on way more risk than you anticipate. So that dynamic management of risk is to look at opportunities not just based on what they are, but also in the context in which they're situated. So this is where if you had 360-degree flexibility, right? Meaning if you could move from one sector or idea to another sector or idea, or if you could move from one asset class to another asset class, or if you could move from, say, an invested asset class to cash, you have that flexibility to sort of play and think about these opportunities in greater detail. And this flexibility actually comes from rebalancing. Because when you understand that something is a performer, something has already performed, and you make that shift, right? You're actually creating more space for your portfolio to grow over a period of time. And this allows you to actually have your cake and eat it too, meaning you're taking less risk, you're not compromising on returns, you're making sure that you're participating at every opportunity, and you get a flavor of everything in one place. So now I'm going to launch, I think, the second poll. And if we could sort of again take this, that would be good. All right. So I think this time around you'll have to type it into the chat because I don't think you can re-vote once the poll is closed. So if we look at the poll results, it's actually quite amazing that everyone here has picked option C because if we think about how this works, right, most people always think that timing the market, that is the time at which you enter and exit, makes a huge difference. Or they seem to think that if you get your stock right, or if you get the asset that you need to invest in correctly, that is what makes a huge difference. But when we really think about how this plays out, timing the market really doesn't work because you don't know when to time the market, right? You actually, if you think, if we look at 2025 as a year itself, you started out in a context where the economy was slowing down. Every month has had its own ups and downs, right? So from September last year till February, you had a period of drawdown. By the time investors thought that, okay, this is going to be a weak market year, between February and March, you had a pickup, and then you had another drawdown. And then the market really shot up in March towards the end. And then in April, you had another drawdown. Um, and then it's been more or less stable. So, and I think even yesterday, contextually, was something that nobody really anticipated, right? For our own, when there were fears that India was getting into a war with Pakistan, you didn't have such a violent market reaction, whereas this, where we're not even the primary participant, you're seeing a lot more market volatility. So I think uh, timing is really something that doesn't work because there are too many variables in the system for you to calculate and know, what is going to be the outcome. Plus, many of these variables are probabilistic in nature, which means there is no certainty that they will occur. There are just variations in which these patterns can emerge. So I'm going to share an important study in the financial space, which is called the Brinson, like the BHB report, right? So what the report said was that if you think about what determines portfolio performance, right? What makes an investor successful? Then in this case, most people prioritize. So if you look at the chart on the right, about 65% of participants felt that picking the right stock is what would help them succeed as investors. About 10%, or rather 20% of people felt that it was some other factor. It wasn't stock picking, it wasn't asset allocation, and it wasn't market timing. So about 7.5% believed that it was timing the market as well as having the right asset allocation that got the investor the best results at the end. But when we actually look at data and see what created performance at any given point of time, almost 94% of or uh, you know 94% of investor returns could be explained by asset allocation choices, and less than 5% from stock selection choices, right? So, and actually surprisingly, even less than 2% from timing the market. So basically, what this tells us is that we need to shift the focus from market timing, stock selection, to asset allocation, because this one thing, getting your asset allocation right, could help you succeed as an investor as long as you're following a particular process. And this data was published by Canara Robeco Mutual Fund. They have a very interesting presentation on multi-asset investing, which I would recommend everyone to sort of go and look at. So obviously, then the solution to a lot of things is asset allocation, of course. Okay. So now when we talk about asset allocation, there's an interesting chart that I would like to share with you. This is something that Livemint publishes every year. Is the presentation visible? Yeah, okay. Because there was something in the Q&A about the presentation not being visible. Are you able to see the presentation now? Okay, super. Sorry. I think they all would have missed. This was the slide that I was talking about in terms of portfolio success. And then this was the slide that I was talking about in terms of asset allocation. So now we look at this quilt or this chart that Livemint publishes every year. The basic idea is that they wanted to look at what is the best performing asset class for each year over a period of time, and how does that actually change across the different years. So when we look at this data point, what you'd realize is there are a few interesting things, but I would like everyone to pay attention to this chart because it essentially shows you where each asset class is in the last 15 years, right? So there have been years where gold has been a top performer. There have been years where global investments have been a top performer. There have been years where even debt has been a top performer, right? And there have been years where your small and mid caps. So this is exactly what I meant by contextual, right? Something can be an aggressive investment when you're taking more risk than you need to, and something can be something like a small and mid cap can not necessarily be an aggressive investment if you get in at the right valuation or at the right time. What is conventionally considered to be aggressive or conservative is not necessarily true. So nobody would expect, for example, double-digit returns from debt, right? But there are almost 5, 6 years in this decade or in the last 15 years where debt itself has given double-digit returns. So if you look at 2012, your government securities have given a 13% return. If you look at 2014, you're seeing a 17% return from this asset class. And in both of these years, this isn't in the top three, right? This is just a good return from debt. Then you look at 2016, where you've got a 15% return. Then 2019 and 2020, where you have almost 12, 13% return from debt. And last year, almost, right, at double digits with a 10% return from debt. So it doesn't matter what you think the asset class is. At each point in time, an asset class is capable of giving you a very different experience. And this builds a very strong case for rebalancing, because let's say you're an investor who wants to make a 12 to 15% return, right? You don't always have to be invested in equities. You don't always have to have a very skewed allocation towards these asset classes. There could be an easier, lower risk way to sort of deliver that kind of return that you're looking for. And this being said, I think we have three important takeaways from this chart, right? So when there is asset allocation within a portfolio, the first level of comfort that an investor can draw on is the fact that there are no years where everything for the investor fails, right? So if we go back to the chart, and I'll do that after we discuss these 3 points so that you can look at the observations. Half of the time in the last 15 years, every asset has delivered positive returns. And the most important thing is losers can become winners and winners can become losers, which means that when you're looking at an asset class, it's not always going to do what it has done in the past. This is why we say, it sounds like a standard cliched disclaimer at this point to say that, oh, past performance is not representative of future returns. And that's because things change over time and we need to recognize that. So quickly to look at this, if you look at the bottom and the top, right, like the bottom and the top rows, you will notice that in the top rows, there are no negative returns, which means that in every year, no matter how mediocre or average the return has been, there has been something that has worked for investors. So I think the lowest return year was 2015, where credit risk was the top performer at 2018, where gold was the top performer at 8.5%. But if you look at the bottom row, I think you realize that, okay, even at the bottom, there are things that can perform well. It's not that every year sees the same kind of outcomes. You do see different things over a long period of time. And when we look at winners and losers, right, we need to study. So take any asset class that you're interested in, whether it's gold, whether it's mid caps or global, whatever your interest is in, just follow where the colored squares are going. So what you notice is nothing really stays in the top three for more than 3 consecutive years at a time. At the same time, nothing remains in the bottom forever. You do see this movement up and down. And I think what you'll also notice is that there are cycles. So if you're looking at, say, gold as an asset class, 2010, 2011, top performer, 2012, close to the bottom, but not a bad return from the asset class. But 13 to 15 was really not a great space for gold. You actually made negative returns if you hold gold in this period. Then you had another decent year in terms of returns at around 10-11% in 2016. Then again, a very mediocre year in 2017. Then between 2018 and 2024, you've actually had a good period for gold, with 2019-20 being brilliant, or even 2024 being brilliant years in terms of performance. And again, after a period of positive performance, you also see a drawdown. So if you look at 2021 data, gold has actually delivered negative returns, right? So even in a decade where something can be a top performer, you will have years in between which are drawdown years. And it's important for investors to be aware of how these movements really occur. So now I want to show you how our asset allocation has moved in Sphere. So we run a multi-asset PMS called Sphere, and it's we invest across the board in terms of equities, precious metals, global investments, fixed income. All of these assets are present in the portfolio. So when we started out in December 21, of course, our non-equity allocation was much higher because we take some time to deploy the assets. And then we slowly built high conviction in equity. So I think our period from 2022 to early 2024 was the space where we believe that equity was the winning asset class. And then you can see the green line from 2024 onwards sort of becoming larger and larger, because we felt that this was a time to move out of equities into other asset classes. So asset allocation matters. You need to have this shift. And usually that shift is more gradual in nature. It's not something that can happen overnight. And restructuring is something that requires vision into where you need to restructure and process in terms of how you need to restructure this. So let's talk about cycles, right? So when we think about cycles, uh, there's a great quote from Seth Klarman where he says that the stock market is a story of cycles and of the human behavior that is responsible for overreactions in both directions, right? So of course, the economy moves in cycles, but it's what we do when we see those cyclical movements that trigger these excesses that you see, right? And I think let's look at how the economic cycle sort of influences asset allocation choices. So broadly, like I think if you look at any economic textbook or if you look at how people analyze the markets, you see four phases, right? So you see a recovery, which means you are exiting a slowdown, but you're getting into the part where you're performing. And the typical sort of structure is that equity tends to outperform in the recovery phase. Then you have your boom, which means that everything is doing really well. You also enter into a period of higher inflation because there's higher economic activity, there's more disposable income, there's more leverage, there's more spending. So commodities as well as equities tend to outperform in this part, right? And then you head into a slowdown where people have to repay the kind of leverage that they've taken. You're in a cycle where spending, discretionary spending comes down, economic activity also slows down. And in this phase, typically you would see gold and cash outperforming. And then if the slowdown really gets deeper than expected, you could end up in a recession. And you tend to see that fixed income as an asset class tends to do well at this point in time. So this brings us to the temperature check to sort of see where are we today. So I think if we look at the global context, you are seeing an economic slowdown. So I think there's a lot of deleveraging of balance sheets that's happening, primarily because advanced economy debt have been much higher than what is historically considered a good level of debt. So there is an unwinding of balance sheets that's happening on one side. There is also a lot of uncertainty around trade and investments. Then you also need to look back home, right? What's happening in India? And when we look at the India story, again, here you see that the economy is slowing down. You are seeing lower GDP numbers come in. You are seeing the World Bank, the IMF, all of these people cut their growth forecast, both for India as well as the world. At the same time, I think one big trend that you're noticing is deglobalization, right? So the number of bilateral agreements that have come up, the number of sort of the uncertainty around trade policy and uh, the kind of tariffs that are coming in. There is some breathing room until July 9, but clearly it's there's a lot of visibility is short term in nature, right? You're not able to see beyond a particular point in time what is going to happen. And that kind of uncertainty can impact how businesses think about where they want to invest, how much they want to invest. And so if private investment comes down, then that reinforces the global economic slowdown. At the same time, you're also looking at how policy divergences are occurring. So the kind of policies that the US is implementing, you're seeing uh, a structure that is more inward, meaning there's a lot more in terms of domestic investments, domestic manufacturing, renegotiating trade deals such that other countries start importing from the US. And while this does a few good things for the US's debt, it kind of brings in a lot more volatility into the dollar valuation, right? So if you want to be an exporting country, economics usually tells you that you need to devalue your currency and make it more attractive for other investors to come in. But the US is in a unique position where it has been an investment destination for a long time. So suddenly devaluing the dollar could actually have a lot of second or third order effects that nobody's really thought about. And I think that's also reflected in how the dollar volatility has been this year. So on one side, you have policies that are aiming for devaluation. On the other side, you're having policies that are aiming for stability as well as an appreciation of the dollar. So how the net effect of all of these forces plays out is something that we're not really able to predict, and there are no models to do this because you have so many variations at play. At the same time, I think today's context, we really need to think about geopolitical risks because there have been so many things that have happened in the last, say, 3 years in terms of global dynamics, in terms of negotiations, in terms of territory disputes, in terms of peace and order as well. More importantly, I think what's coming to the forefront is that you have different uh, economies that have been responsible or that have control over key resources. So in the past, I think oil used to be the only thing that you would look at, but now gold is becoming a commodity that's in focus. You're also thinking about rare earth metals. You're also thinking about the inputs that go into semiconductors. So there are many things that are actually now coming back into the uh, framework of supply demand, right? So even if you think about energy resources, if you're thinking about coal, etc., these are all things that we need to start paying attention to because supply and demand are completely dependent on negotiations as well as trade policies that are in place. So, given today's context, we need to start thinking about the quilt that we looked at and how this quilt shows us that performance changes over time, asset classes move from the top to the bottom. So, one interesting data point that Bandhan publishes is about how performance chasing actually is a very counterproductive strategy. So, if you go into last year's winner, you tend to typically lose on the returns perspective. So if you're an investor who's actually worried about returns, while it may seem very counterintuitive to think about returns like about returns on a forward basis, right? We typically take confidence or we feel more comfortable knowing that this asset class has done well in the last few years. And that gives us the confidence to participate in that particular asset class. But when we do this, we actually tend to lose out on getting the performance early on, right? So when you chase performance, there's almost a 1% compounded difference over 13 years in terms of how a equal weighted strategy performs. So you're not even optimizing your portfolio in this case. If you just take an equal weight between A, B, and C, and you look at, say, in year W, A is the best performer, and then in year X, you choose to invest in that. That is performance chasing, right? So when you chase performance, you're actually losing out on returns. And there's a really good quote from Howard Marks also, which says that, what a wise man does in the beginning, the fool does in the end, which essentially captures what we shouldn't be doing when we're looking at asset classes and how we structure performance. So we looked at a chart for asset classes, but I think even sectoral calls matter a lot. So when you're looking at sectors, I'd like to walk you through a few things that Sphere has done since its inception. So I think we were very early in the PSU as well as the PSU bank call. So prior to the PMS, we ran an investment advisory business. So our allocation to PSU started through 2019-20. And this was a very early phase in terms of when you're building. So if you look at where PSU banks are in this period, you actually see that it's at the bottom of the pile, right? And then we got out of PSU banks between 22 and 23. So our exit also happened then. And then you can see that there was still a year of performance for PSU banks, but it was nothing like what had happened in the past 2 years. So being early, timing your exit, leaving that last bit of returns for somebody else to take is actually not a bad call. And our early exit, so if you look at where PSU is in terms of year to date as of April, it's really not at the top of anything, right? So for somebody who came into this story a little bit late, the average returns over the last couple of years would not be that great. So the idea of not chasing performance and getting your sectoral calls right early on makes a huge difference. So another theme that we exited in 2024 was infra, right? And if you think about so if we look at one theme that we didn't participate in 2024 and we actually exited out of was IT services. It was something that we built through 22, 23. So the idea is that sectors also rotate, and knowing where the sectoral rotation is happening is very important. The core themes in Sphere today are so private banks have been a very important part of the Sphere portfolio. Banking and financial services have been the foundation for a long time. And you can see that, again, these positions are built over time. It's not built overnight. And you can see that this is a year where that sector is actually playing out. But in the last couple of years, returns have been kind of flat in terms of where you are relative to the whole market. So this is where I think we can look at the word cloud poll. And I had asked, what do you think is good investing? So if you haven't answered on the poll, I think you can just type it into the chat box. Let's take a look at what good investing means to each of us. Okay, so asset allocation. Uh, okay, systematic investing with asset allocation, knowing your goals. Yeah, all great answers. I think even if you had put returns, that's a good answer because as an investor, you are concerned with that, right? All right. So I think before we close the webinar, just a few slides in terms of what does rebalancing do for you. I think first you need to look at the weather check. So we took a temperature check today to understand where we are from a macroeconomic context. And when we do this, it makes way for new ideas and themes in the portfolio. Then I think if we follow this past to future strategy, meaning you do look back and you do look at performance in the past, you do look at how things have played out, but you also start looking ahead. It's not just based on what happened last year or the last 3 years or the last 5 years, but it's about what can happen in the future. And when we do this shift, right, from just thinking about the past to also thinking about the future, better ideas come into the portfolio. And of course, lastly, to have high conviction investing, meaning you need to have focus, you need to have discipline, and you need to participate continuously. So I think someone had put out a response saying that systematic participation in all asset classes or participation in all asset classes. Now that is high conviction investing, right? Because it ensures that there is a discipline in terms of continuous participation. There is a discipline in terms of allocating to different asset classes, but you're also maintaining a focus as to where you need to prioritize your savings. So now I'll just walk you through a few things on Sphere. The first is in terms of performance. So if you look at our performance, we've comfortably outperformed all of our peers. And I've benchmarked against our standard index, which is the Nifty Multi-Asset 50-40-10, that is equity, arbitrage, and rates and InvITs. Then we've also benchmarked against the Nifty 50 as well as dynamic asset allocation funds as a category, multi-asset allocation funds as a category, as well as FlexiCap as a category. Now, why are we benchmarking against FlexiCap when it's pure equity, whereas we are predominantly a multi-asset fund? I think the logic here is that if you looked at that asset allocation data, given that we're a young fund, right? There has been a period where we've had a fairly heavy allocation to equities. And given that context, I think it is only fair to also benchmark against a pure equity product. So quick snapshot of our performance from May this year. So again, here we've comfortably beaten the benchmark across all time periods, including the toughest period between, let's say, September last year and March, April this year. So now let's also ask the tough questions. It's good to do well on the upside, but what about the downside? And I'm going to share two snapshots of drawdown data. So on the left-hand side, we're looking at the drawdown from the Nifty's all-time high, which was 26 September last year, to the all-time low, which is in March this year. So if we look at how the Nifty performed in this time frame, it lost close to 16%. Sphere, on the other hand, only lost 10% in this time frame. The multi-asset index, of course, lost even less with about 8.5%. And the Nifty 500 lost more because you had a steeper correction in mid and small caps, where that loss was almost 19%. So now we look at Sphere's all-time high till its all-time low. Then similarly, our all-time low actually happened much earlier than the Nifty's all-time low, and our recovery period from there was much faster, right? So here you see that the Nifty lost close to 12%, whereas Sphere lost 10.5%. The multi-asset index lost much less at around 6%, and a pure equity index like the NSE 500 lost around 13%. So now, because we talked about rebalancing, let's also look at whether there's a lot of churn in this portfolio. So in 2021, this data doesn't really matter because the portfolio is less than a month old in that year. So what we did in 2022 was to trim certain positions, and I put two items that we trimmed here, but they're actually the same theme. And if you want to take a guess as to what we trimmed, that was PSU banks, right? So that was a year. So I told you that between 2022 and 2023, we exited this entire idea so that we stayed out of this theme. We got in early and we got out also a little bit early. So if you look at it, you don't really have too many churns. If we do see why is 2024 showing such a large number, I think what we can understand from this data is that we made that asset allocation shift, right? So we showed you start of 2024, what was our equity allocation? It was up, it was almost more than 80% in terms of market value was equity allocation. By the end of the year, we were closer to 66, 67%. So that shift, that power of rebalancing that happens is what creates the alpha as well as protects the investor from market volatility. So a quick view of the terms of investment. We are a SEBI registered PMS, so the minimum investment mandated by SEBI is 50 lakhs. Our benchmark is the NSE Multi-Asset Index 1. There is no exit load on our product, so anybody who comes in is free to take out their investments at any point without an additional fee in terms of exit load. So we have a 1.5% fixed fee. There is no performance fee. So even in a year where you tend to do better than the expectation setting of 12 to 15%, there is no additional charge that's there. Of course, this excludes GST and other expenses, which would be at actuals. So your custodian expenses, etc., would be add-ons into this. So who is Sphere for? I think if you have a moderate risk appetite and you're looking for that sweet spot where you're not compromising on returns, at the same time, you're not taking too much risk, and you have a longer investment horizon, right? So the horizon of 5 to 7 years makes sense because that's when you can actually experience at least a part of an investment cycle, or you see these asset allocation shifts that occur. So we have a very flexible mandate in terms of being able to allocate between 0 to 100 in any of the asset classes that we choose. And we also have a cap on what the single stock exposure can be. So if we start thinking about winners versus losers, if we start thinking about Learning Saturdays as an initiative, this slide needs to be updated. If we could just spend each day trying to be a little bit wiser than when we started, I think this is the initiative that I talked about at the start of the webinar. So if you'd like to be part of Learning Saturdays, you can reach out to us and message us, and we'd be happy to put you onto our broadcast channel where you can stay up to date as to what all webinars are happening on a weekly basis. You can sign up for any of them or whichever ones are interesting you, and then you can sort of make productive use of your Saturday as well. So with that, I will open up for Q&A. Let me just see if there's anything on the Q&A section. No, there's nothing here. So happy to address any questions that have come in the chat or anything else that you want to talk about. Thank you, sir. It's very sweet of you to say, and we're happy to note that you are our client. Okay, investing regularly, continuously is important. Agreed. But once you reach 1 to 2 crores, what happens if you can't invest regularly for whatever reason? Because there are job losses or you're retired and you don't want to touch this money for 1 or 2 crores. Is this still good compared to not investing regularly and not pulling the investments frequently? Yes, of course, staying invested is as important as continuously investing. And of course, through your life, your ability to participate will change, right? So for a young person, maybe they're not going to be able to capture every opportunity because they don't have the liquidity. But as you progress in your career, you will be able to scale up. And that's the phase where you need to maximize your participation, right? And this means you would essentially be adding to your portfolio as much as possible. When you move into retirement, it is completely okay for you not only to not participate, but also to draw down from your portfolio, because that's why we save. If structured in 2 ways. So typically when we work with a retired investor, we tell them that you need to have 2 buckets in your portfolio. One is going to be your growth bucket, and Sphere can fit into this bucket, right? Where it's just there, you're not contributing to it in any way, but you're allowing the investments to grow, you're not disrupting the compounding. And then you have the income bucket, which is designed to basically give you a regular income through your retirement years. And then your income bucket will get topped up from the profits in your growth bucket. So this cyclical rebalancing also happens. So I think this is great. Like if you kept your investments in Sphere and you're not drawing down, but you're not able to participate for genuine reasons, that's fine. I think the real thing is that when you miss participating because you're sitting on the sidelines, right? So in the beginning, we talked about the investor's dilemma. So sometimes we see that people don't participate because they're worried about whether this is the right time to invest, whether they're participating in the right asset class. So these are things that I think should not hold you back in participation. But if genuinely your life circumstances don't allow you to participate, it's okay. That's just part of the journey. We will not be sharing the PPT with anyone, but this webinar recording will be available on YouTube. So anytime that you want to watch it, or if you want to go back to a few slides, that should be available. During rebalancing, gold considered as debt schemes or equity schemes. So that split was for equity versus non-equity. So gold is in the non-equity part, but it's not considered as debt by any session. I think what makes sense is that you look at gold or precious metals as a separate asset class, you look at fixed income as a separate asset class, you look at global as a separate asset class, and you look at domestic equities as a separate asset class. How do you course correct if rebalancing can go wrong? I mean, whether there is any tracking period or mechanism. Of course, I think the most important thing is to be swift, meaning, let's say you make a decision which is wrong. We shouldn't be anchored to that decision, right? In the sense, you have to accept that it's a mistake. And if you look at where performance comes from in a portfolio like Sphere, it's not that 1 or 2 things have caused the entire portfolio performance, right? You have broad-based performance. So you don't have a few outliers that have contributed significantly to return. You have broad-based performance. So that is basically your selection has to be really good and your response also has to be really good. There have been times where we've had to rebalance because your thesis no longer holds. You might make a particular investment with a particular expectation or based on certain reasons. If that doesn't work out, you have to rebalance. So there is a mechanism in that sense. The process is very robust. You do review the decisions that have come in, you do review the thesis, and you see whether that thesis is playing out over a period of time or not, right? And sometimes you can have delays which are acceptable, but sometimes you know that it's not going to move in that direction anymore and you have to course correct. So that's definitely there. Okay, so in all or most of your programs, you guys seem gold agnostic or opposing, but off late gold is the one asset class that's really gone up. Also, considering the current geopolitical tensions and uncertainty, it's gold that will be handy, but most financial advisors never advise gold at all. So why, please? Okay. Firstly, I would not like to speak about any other financial advisors. I don't think we've been opposed to gold. If you see, our biggest call in 2024 was actually to move into precious metals. And we have been participating in gold as well as the precious metal basket from 2018 itself. And this is something that we have advocated for all of our clients. Even on the mutual fund side, you do have clients who have participated in the precious metal basket. So that would be gold, silver, and minor. You can also go back and look at the videos that we have put out across our different channels and platforms where we have talked extensively about these topics. So I don't think it's fair to label us as against gold. What you might be perceiving in terms of being gold agnostic is the fact that within a decadal cycle as well, you can have periods of drawdowns for a precious metal investor, right? So I think there is data which shows, say, the last performing decade for gold, you had almost a like a huge performance gap. But when you look at the chart in terms of how gold prices move, you could have periods of drawdowns where gold loses anywhere between 5 to 25% of its value. So the idea is that you need to rebalance, right? There are investors who can stomach that 25% drawdown, especially if you started in a much earlier part of the cycle. Because then that 25% drawdown isn't much because you've already made, say, 30, 40 percent of returns in that particular asset class. So it is a more contextual decision as to who can tolerate it, who shouldn't tolerate it, and why that lateral shift between asset classes needs to happen or not. But your point is valid. That is, considering today's geopolitical tensions and the uncertainty that is there, precious metals do have a place in every portfolio, and that is something that investors need to focus on. So unfortunately, there is no fixed number of years. Like you can't say that a market cycle takes 5 years because sometimes you see things play out in 5 years, sometimes you see it in 7 years, sometimes you see it in a decade. Some trends are even longer, right? So if we look at, say, the US's debt, that cycle has been playing out since the 2008 crisis. But if we look at the previous period, that is, how did they get to low interest rates? You have to go back to the previous crash, which was your dot-com bubble. And then if you understand what led to the dot-com bubble, it's actually like the Volcker era of high interest rates. So cycles can play out in longer terms, but those longer cycles, you don't actually notice the day-to-day changes. It's only in hindsight that you can see that, okay, this was the big trigger for all of these things to happen. But I think from an investor's perspective, you will definitely see significant macro changes in blocks of 5 years. And that is something that you can keep in mind. How is the geopolitical situation considered in rebalancing? I think you need to look at everything from a contextual perspective, right? So let's say like today we're looking at a world where you're looking at more bilateral trades, you're looking at deglobalization. You're also looking at a global economy that is much slower than the domestic economy, right? Both are slowing down, but the global economy is significantly slower than the domestic economy growth. In this case, maybe you would want to look at more domestic focused companies. You might want to look at companies that are like multinational companies that are allocating more towards India. You might want to look at hedging with certain other asset classes. So you could have precious metals, like another participant mentioned, or you could even have fixed income that comes into this. So whether you're looking at politics, whether you're looking at the economy, whether you're looking at macros, all of this would influence your rebalancing decision. Sphere is comfortable or MF is comfortable for holding a 1 crore portfolio for a retired person. You can consider both. We do have investors who are in Sphere who have already retired, and this is their growth bucket. We have investors who save their retirement money over a period of like 15, 20 years, which will eventually fund their retirement in Sphere as well. I think the advantage of having a mutual fund portfolio is if you're looking at a growth plus income bucket, I would suggest the growth bucket go into Sphere as a portfolio and the income bucket go into the mutual fund side. But entirely up to you. I think this is a very personal decision and it requires a one-on-one conversation. So if you would like to sort of talk about how to do this, I'm just dropping our number here on WhatsApp, and you can feel free to just drop a message saying that you want to talk about your retirement plan, and someone from our team will get in touch and help you decide what you need to do, how that split needs to happen across your different products. I think at the scheme level, we're close to about 5% in gold. When the market is overvalued like today, and rebalancing strategy is to reserve, add up funds into debt funds, to pile up these funds instead of cash, and the time is right opportunity when the market falls to exit the debts and enter into equity or other value. So I think one thing is clear, like I showed you a churn, right? The exit in any asset class has to be on the merit of exiting that asset class. Meaning we will not just sell to buy something else. This is true of owning stocks. This is true of owning different asset classes. I think the exits are always based on whether it makes sense to exit that or to hold onto it, right? So rebalancing is about de-risking. That is the approach that we have at iThought. So when I'm looking at, say, an overvalued market, which it's very difficult to say today whether it's overvalued or not, right? Because if you think about it from a domestic context, maybe you are seeing some overvaluation. But when you start looking at it from a global context, if other economies are really not growing as much as India is, then there is a risk of FII flows coming in and changing valuations altogether. So for an investor, you need to tread that fine line between what is it that you want, what risk is it that you want to accept versus what risk is it that you need to be prepared for, right? So I think that's the basic idea. We look at things from a cyclical perspective, meaning cyclically, if it makes sense to enter fixed income, we will enter fixed income. When it makes sense to exit fixed income, we will exit fixed income. Then at the same time, if we feel that equity valuations are very high, we might look at doing this. But the idea is not to buy debt and then sell debt so that we can buy equity, because that is more of a balanced fund approach, right? You maintain some amount here, some amount there, but that's not the strategy here. This is more dynamic. This is more contextual. So I think we've reached our 12 o'clock mark. So once again, thank you to everyone who's been here and who's participated, who's asked questions. Do feel free to write to us whenever you want. If you have anything else that you would like to discuss, we'd be happy to sort of talk to you, have a more detailed conversation, and take this forward from there.